I keep seeing that angel investing is very addictive once you start it off. It's very difficult to stop. And so it's been consistent thereafter. There has been definitely periods of a bit of slowness, but that's because of the market conditions or cash flow, but the temptation always continues, right? The reason that I started is because by then I had started getting a reasonable good exposure to how startups operated and how they scaled and how they were disrupting, right? And the fact is, you already kind of knew what kind of founders were building startups. These are startup founders who are extremely talented, and there's logic very clear that you don't create wealth from salaries alone, so you need equity to do that. So if you can use your safety net, which is salary, invest that into smart founders who technically work for you and build your wealth over a period of time, right? Why not, right? I mean, I keep saying that investors have less to lose, at least from an angel investor perspective. The founders who have taken the leap of faith into building have a lot more to lose than what angel investors would lose in terms of small tickets. So yeah, the journey has been rewarding, not just financially, but in terms of learning. And yeah, it's been about 4.5 years.
Hello, ladies and gentlemen. Welcome to yet another episode of Invest with Dexter. Quick recap on Dexter. So, Dexter has been at the helm of early stage investing in startups for the past 3 years. Over the period, we've invested in about 31 companies so far across the spectrum of consumer tech, healthcare, B2B SaaS, fintech, AI, and ML. With this initiative of Invest with Dexter, my 2 point prerogative is to first, bring forth the stories and unfold the stories of individuals just like yourself from different walks of life who have started, angel investing over the past 2, 3, 4 years, and how they've gone about with it, what their experience has been. And second, being to encourage you to, take this leap of faith and explore this asset class for investing. As we know, the next decade belongs to India, and why not have you as a part of, this slice of success? Without further ado, I would introduce my next guest for today. Hi, Abdul. How are you?
I'm good. How are you?
I'm doing good too. So, Abdul, for the benefit of our viewers, we can start with introducing yourself.
Sure. So I'm based out of Jakarta, Indonesia. I kind of shuttle between Jakarta and Manila for now. Currently, the co-founder and CEO of Have. It's a health and wellness startup that operates in a few countries. It started off doing that about 2.5 years back. But apart from that, I'm also the managing director for Pulse 63, which is a healthcare-focused venture builder, accelerator, and a fund. Prior to all this, I used to be the CFO and Chief Business Officer for Shipper, which is a full stack logistics startup based out of Indonesia. Was with them for about 2.5 years. Prior to which I worked with Delivery back in India. And prior to that, with a French unicorn called Miro leading the APAC business. And prior to that, with Oyo leading the Middle East, to be specific, Saudi Arabia. So been in the startup space for about 7, 8 years. Yeah, that's about me.
Great. Thanks, Abdul. So you've seen all spectrums of the startup ecosystem, right? From being an operator to being an investor to being a part of multiple unicorns for that matter, Indian and global. Help us understand, apart from the operating experience, what was your motivation behind starting to angel invest? How many years has it been? What got you into it? And how has your experience been?
I think I started about 4.5 years back, right? I keep seeing that angel investing is very addictive once you start it off. It's very difficult to stop. And so it's been consistent thereafter. There has been definitely periods of a bit of slowness, but that's because of the market conditions or cash flow, but the temptation always continues, right? The reason that I started is because by then I had started getting a reasonable good exposure to how startups operated and how they scaled and how they were disrupting, right? And the fact is, you already kind of knew what kind of founders were building startups. These are startup founders who are extremely talented, And, there's logic very clear that you don't create wealth from salaries alone. So you need equity to do that. So if you can use your safety net, which is salary, invest that into smart founders who technically work for you and build your wealth over a period of time, right? Why not, right? I mean, I keep saying that investors have less to lose, at least from an angel investor perspective. The founders who have taken the leap of faith in a building have a lot more to lose than what angel investors would lose in terms of small tickets. So yeah, the journey has been rewarding, not just financially, but in terms of learning. And yeah, it's been about 4.5 years now.
Great. Thanks, Abdul. Brings me to my next question. Since you've been investing for the past 4.5 years, how many investments so far, and what has been your sectoral focus?
So I've invested in over 140 startups by now, actually. A large portion of that based out of India, a bit of that in Southeast Asia, and a bit in the US, right? I'm sector agnostic, stage agnostic. Now, however, there have been sectors where I've had a larger uh, sort of bias, and that have been healthcare, direct to consumer, SaaS, fintech. These are sectors where I've had larger exposures. There are sectors once in a while that I kind of stay away from, but that kind of evolve, right? If I stayed away from a sector a few years back, not necessary that I continued staying away from that sector years later. The one sector that I'm completely against is Web3, though. Yeah.
Okay. And the reason being?
I just don't understand it.
Oh,
I
got it.
mean, I honestly think it's a bit of fad that way.
Because everybody is all gaga about Web3. Those who are taking exposure in Web3, they are pretty much against Web2. So they consider Web3 to be the next thing. And since you have had a very, very large exposure, 140 plus startups, that's quite a number, right? So that was the idea behind getting your 2 cents. So yeah, it's pretty clear that things which you understand, you want to take a bet on, maybe even a larger exposure for that matter, despite not worrying for the outcome, right? Because every investment will teach you something. If not financial returns, it has some sort of soft dollars or knowledge returns attached to it, I guess.
I agree. I agree.
Great. So, Abdul, help me understand, since your startups exposure has been more than 100 plus startups. If you could throw some light on a few success stories and a few stories which didn't go the way it should have, so that will help me put a lot of perspective to the further round of discussion.
Perfect. I think the closest to heart in terms of success is FleetX. So FleetX is a SaaS company that's based out of Gurgaon, and they're building SaaS products for transporters. And I invested as early as they were starting off, I think, just a few months into their journey. They've done extremely well, right? I mean, the latest investor in them was India Mart, I think, who did close to a $20 million round in them. They've done really well for themselves. Great team, great technology, picked up a sector that had real problems, continued to scale there efficiently in an extremely seamless manner, sort of. But apart from that, I would also think Infido was another great outcome for me, right? I mean, they've been at it for a while. I mean, it's now 8-year-old business, but I only entered the company about 2.5, 3 years back, and they've done really well. The kind of new clients, the kind of revenue growth, the kind of retention, kind of NPS, the kind of customer love that they kind of showcase, and just not in Indian markets, but globally, right? Is really good, right? I don't think I've ever seen a company that's product focused and kind of achieving those kind of numbers ever, at least from that kind of a lot. I've had I also think Fellow, the ones that we invested together, is a great outcome, honestly speaking, right? I think Fellow, as you know, we did it together. We did it through Dexter, honestly speaking, right? So Fellow, which is a micro savings fintech, has done well. Even Pilgrim, honestly speaking, a direct to consumer brand that we did together, has done really well. What hasn't done well, I would take one example would be Fable, unfortunately.
Okay.
So I invested, I think, about 2.5 years back. Year and a half later, we had a great exit opportunity. I chose to exit, but considering that we were part of a syndicate, everyone else chose not to. And then because of that, I couldn't exit. But if I had exited at that point in time, I would have had made good outcomes. But a year later, hey, as you can imagine, it's been in troubles,
Mm.
as per all the media reports. So I think that's what's not gone well for me, but I think that's part of the game anyways.
Yeah, true.
Yeah.
Great. So, what I can conclude from this as well is the fact that the entry point as well as the exit point are critically, very, very important in the angel investing journey as well. Of course, you make money over a longer period of time, but when to enter and when to exit is equally critical. And whether it is an investor's choice or whether best left to your fund manager is something we can definitely, evaluate over the longer period of time. Help me understand, what do you think, since you've been invested for about 4.5 years, what according to you is the ideal time to exit, and where do you see your money, really making returns? What is the ideal holding period for a startup investment?
I think it's very difficult to define that, right? Because one, it's an illiquid asset class. I mean, even if it's done well, it does not necessarily mean that you get a secondary offer.
Correct.
So I would say, I think it's very difficult to define it from that perspective. But I think, honestly speaking, considering where early stage investors come in, like angel investors, it does take at least 2.5 to 3 years for the business to kind of start going on a consistent growth trajectory, because the first 2.5 years, you're kind of figuring it out,
Mm.
sort of, right? So I would say anything between 3 to 7 years is the right period.
Right.
And yeah, honestly speaking, exits, I mean, I would even say it's not about, I mean, it is important when you enter,
Mm-hmm.
but it's more important when you exit, and do you exercise that exit, right?
Correct.
Because at least protect your capital or take
Mhm.
some upside and reinvest in others. I think it's super critical to know when to exit and how to exercise exits, right? Because they don't come by as much as you do want it to.
Absolutely. So, brings me to my next thought of, next set of questions around exit, or maybe, managing your funds. In startup investing, as an individual, you would have a certain limitation to putting funds, and compared to any institution, you would have limited rights. Do you choose to propose whether you should go via a funding route, a route where, pooled in capital is considered, or an institution who's managing your funds to be your channel of startup investing, so that at least your exit rights or other, channels of where you're exercising your information rights, exit rights, preemptives, and everything else is ensured?
I think it's very it's not a binary sort of option, right? I think it's important for individual as for us as individuals to get exposed to that realm of the world, in terms of being able to source deals, in terms of being able to get allocation on the cap table, in
Correct.
terms of maintaining that relationship and all of those.
Mm-hmm.
But I think it also is important to work with syndicates and fund managers, because they do this full time,
Mm-hmm.
right? They understand this a lot better, and they also have sort of a lot of credibility at stake, right? As I think it is important to try both worlds.
Mm-hmm.
Uh, but if you don't have the risk appetite, I mean, as an angel investor, you have to have extreme levels of risk appetite. But even if you were a few steps behind, then you should work with a fund manager, because as an individual, you will kind of not get the same momentum of time space that you get with founders as the startup kind of becomes bigger and bigger, right?
Correct. Correct. So, brings me to my next question, Abdul. You've been with Dexter for more than 3 years now. You've seen us grow through the close quarters since inception. How has your experience been with both on the positive and the negative side for that matter? Please feel free to be as candid as you can as to how Dexter's journey has really, been being with Dexter has really provisioned all of these above mentioned factors which you were just mentioning, and how has your overall experience been with Dexter as a fund manager?
I think Dexter, there are a few things that I love about it, and not for the sake of this conversation, but I've
Mhm,
had this mentioned to a lot of other people, right? I think the only other micro fund or syndicate where I have seen a well thought through research document is Dexter, right?
mhm,
A document that's research for the purpose of research and not a document to push people to invest, right? I think I love that perspective of it. This is one place where I've seen, despite commitments coming through and despite founders being great, where agreement related clauses which are not investor friendly, or if there has been any sort of light red flags as well in DD, Dexter walking out of those deals, right? I don't think there's been a lot of other instances where I've seen something similar outside of Dexter. I think these are two good stuff that I love.
mhm,
And the fact is also the sector focus, right? I think you don't go too broad. I mean, but you pick segments that you understand from the larger Dexter Capital Advisors sort of family, from the larger networks. I think it's like pick and choose what you understand really well and continue to do that, right? And if the expertise doesn't exist in the network, it's kind of asked from external family sort of network and kind of understood, right?
mhm,
uh, what I don't think we did good as Dexter is, I think, could not get a larger pool of people together. And because of that, ticket sizes could not be meaningful enough in some of the cases for startups, right? I think the ability to communicate what Dexter is, the way it works, the whole narrative wasn't done as well, unfortunately. And because of that, not a lot of people coming along in the journey and trying to build this group or ecosystem, I would say.
mhm.
Yeah.
Great. No, thanks, Abdul. Puts a lot of perspective here, but I like two cents out here. So, one, the idea of creating Dexter as an investment channel from day zero was to create a fund, right? So, syndicate or a network approach, which you would have seen with multiple other players in the market who've grown to thousands now, and we are sitting still on hundreds, right? The idea was always to make sure that, the syndicate still remains a channel of creating track record. And now that we are on the verge of launching our fund, where typically we could take meaningful bets, which you rightly mentioned, that the check sizes have been fairly smaller to what it could have been over the period of time, and taking more concentrated bets, doing more thorough diligence around companies, which has been our forte before backing any of these companies, and not doing just for the sake of it or spreading too thin, is something we are trying to achieve with the help of the fund, where we don't have to manage multiple LPs but manage LPs money more effectively, is what has been our forte. And hence we have been very selective on whom we make as a part of our syndicate or our network, since you've referred so many people to our network, yourself. So you've seen that journey. Of course, that has a positive but a negative connotation to it as well. So yeah, balancing both sides of it, and hopefully with the fund we can take more meaningful bets and do a more thorough investment job, rather than spreading too thin across the ecosystem. So
No,
yeah,
I
that's
I
that.
think the fund was a good evolution for Dexter, and I think it was done at the right time. Honestly, right? The track record is in place. The conviction is there.
Correct.
Yeah, I think it's a great transition.
Mhm. Great. Thank you so much, Abdul. So, before I move on to yet another exciting segment for our podcast, some closing thoughts on people, or your advice to people who are just about fence sitting, wanting to start their startup investing journey, or just about looking at this asset class. apart from having exposure to all other, traditional asset classes of investment. What is your 2 cents for them and your advice to them?
I think this is an asset class where you kind of don't look at this asset class purely for the financial returns, right? This is an asset class where you would learn new technologies, new ways of doing businesses, new challenges. You will build a great network of smart people, co-investors, founders, all of those, right? I think this is an asset class which gives you much more than the probable financial returns that it can, right? Second is you have to start somewhere. Unless you don't start, you don't get to know how this looks like, right? But only start when you have decided that the moment you write that check, you will treat it as written off, right? Unless you don't treat it as written off, please don't, right? And do not expect founders to be your employees. Technically, founders are not your employees. I mean, they have multiple investors, they have business to run, they have employees to kind of take care. Their responsibility is to take the business to the right stage at the right time in the right manner, right? And there could be a lot of challenges that the founders are dealing with. What we should be doing as investors ideally is believe in them. And if we write the check, let them operate the business. If they have trouble, if they need assistance, they will most likely come back and say, oh, you know what, this is happening. Can you help me, right? And when that request comes in, be helpful super fast, right? Yeah, I think great asset class. As I said, super addictive.
Great.
Know to hold on to your temptations.
Definitely, that makes sense, and it clearly reflects from your, angel investing journey where you've put in 100+ bets over just about 4 years. So definitely speaks for the volume of the addiction you have for this asset class.
No,
So
agree.
yeah, thank you so much, Abdul. I'll move on to the next segment of my podcast. While I don't have any copy or current for you, and uh, my hamper to you comes only when we make some handsome returns for you on your portfolio. I'll move on to the rapid fire round. So, three things you look at when you invest in a startup.
I look at the founders for sure, right? I usually say, yeah, it's rapid fire, so I shouldn't be answering it in detail. It's the founder, it's the space that they are in, it's the vision that the company has, or the founders have for the team or the business. Yeah.
Okay. Three red flags you look at in a startup.
Someone who's not full time in the business is a red flag, or kind of somebody who has a plan B. That's the first thing. Second is where product is going to take 9 to 12 months. There's no conversation around sales and distribution.
Mm-hmm.
Third is any significant connects with family businesses, becoming a supplier or becoming your largest customer or your investor.
Okay, got it. Three sectors you would like to take a bet on for the next 10 years.
I would say I will still take bet on D2C businesses.
Mm-hmm.
I think that's a space that I love. Second is fintech, primarily B2B fintech, not as much on the B2C side of things. Third is health as a sector, correct.
Okay. I'll move on to the next segment where it's more situation based answer, this or that. So, founders with a strong institutional background or founders with strong operating experience in that domain?
I actually would, I mean, it's not this or that for me. I mean, I keep telling what's my thesis. I like founders who've been senior positions in high growth startups, or ex-VCs becoming founders or second time founders. So it definitely is for me, this three. And unfortunately, in the two options that you gave, all these three fits in some or the other way. Yeah.
Okay. Large market with several VC funded players or growing market with some white space or gray space?
I would say small market with some white space.
Okay. Here we have three options for you. Startup which is profitable from day one, startup with profitability in the foreseeable future, startup which is hyper growth focused, and profitability should come when it comes.
Uh, for today's day and age, I will go with exactly the same sequence as you said. So companies with profitability from day one, going into companies with path to profitability or visibility to profitability, and companies which are hyper growth and profitability is a question mark. So exactly that sequence.
Got it. My final question to you, pre-seed or seed startups with a lucrative valuation or startups having achieved their PMF but at a premium valuation?
Companies that have achieved PMF with high valuations.
Okay, got it. Great. Brings me to the end of this conversation, Abdul. Thank you so much for your time. And it has been a pleasure speaking with you after having invested so much across the ecosystem. It was great to receive your perspectives, and I hope our viewers can benefit a lot from your views as well. So yeah, thank you so much for taking out time to speak with us.
Thanks for having me. It's been a pleasure working with Dexter. Hopefully looking forward to a lot more deals together.
Mm.
Thanks.
Yeah, great. Thank you, Abdul.